What about Bitcoin miners? I know you touched on this in the report, and they seem to be kind of taking a back seat because of all the contagion and that, but they haven't exactly had a great year either.
No. Yeah, I think this has probably been the toughest year for Bitcoin miners ever. When you look at kind of the variables that go into being a successful Bitcoin miner, you're essentially, long Bitcoin spot price, and then your short hash rate and your short energy costs, right? And so when we look at the three of those components, they're going in the complete opposite direction as what you would ideally want to see, right? You have Bitcoin spot price down 75%. You have global energy prices at multi-year highs, and you have hash rate near all-time highs, which has actually been increasing. It's come down a bit over the last few weeks, but it's actually increasing as Bitcoin is trading down at 15, 16K, which is absolutely mind-boggling. I'm unsure exactly who the entity is that was piling on hash rate. Maybe it was just because a lot of these miners were like financed with debt, and previously that wasn't the case. But nonetheless, that's just been making the outlook for miners this year incredibly difficult. So their margins, and one way to look at this is through hash prices. You can compare miner revenue divided by hash rate, and what essentially you get is the price per terahash. And so when you look at that, over time that perpetually declines because you have more and more people that want to mine Bitcoin, so it becomes increasingly difficult to do so. But we've just, over the last few months, made more all-time lows. So every week I check it, it's at a new all-time low, basically showing you that margins continue to get more and more compressed. Another way to look at this is something called the Puel multiple, created by our buddy David Puel over at ARK Invest. What essentially this looks at is miner revenue divided by the 365-day moving average. So you're essentially gauging, how much revenue are miners bringing in relative to how much they brought in over the last year. And so that also is at, relatively historically low readings in addition to hash price. And so when we look at, something called hash ribbons, which looks at two different moving averages of hash rate, according to that indicator, which tries to identify capitulatory periods for miners, we've seen two capitulatory periods this year for miners. The first one took place in June. At the time, you had the 30-day moving average of hash rate cross below the 60-day moving average of hash rate, which was an indication that we entered a capitulatory period for miners. During that time, you saw Core Scientific sell, I think it was 7,202 BTC for like 170 million in proceeds, which bought them some time, but now they weren't able to kind of weather the storm, and we've seen, they're undergoing some type of restructuring at the moment. And then you also saw, looking at on-chain data, you could see that the kind of miner wallets, which basically the way these data providers track them is they can just look at the Coinbase transactions, coming directly from the Bitcoin protocol as mining rewards, and then tag the wallets from there to see, the heuristics around how the wallets are moving around, and then get a gauge of, okay, this appears to be a miner wallet. And so when you look at these miner wallets, you could see back in June that a substantial portion of BTC was also sold off. We came out of that capitulatory period and then just entered another one roughly a month and a half ago. And with that, we saw an immense amount of sell pressure come from miners. Tens and tens of thousands of BTC were sold onto the market. And then recently, over the last week, we've finally seen that 30-day change in their holdings actually flip positive. So, potentially kind of coming out of that period, at least temporarily. I think historically it's been a good indicator of kind of macro bottoms for BTC. This is the same thing that took place at the end of 2018. I think that kind of leg down from 6K to 3K at the end of 2018 was mostly all miner selling. You can also see that, reflected in the on-chain data. And I think, I guess just to kind of wrap up on Bitcoin miners, I think some of the key takeaways here are, if you are looking at, purchasing, Bitcoin mining stocks, I would say, look for miners that have, fixed energy contracts, right? So they're not susceptible to the, crazy volatility in energy prices that we've seen this year. And also look for miners that have very low debt. With any company, you want to have some degree of debt to, help your growth. But I think with Bitcoin miners, it's a little different because it's just such a cyclical business. The volatility of Bitcoin and also, hash rate is just absolutely insane. So I think you kind of have to approach, holding debt on your balance sheet differently than you would traditionally. And, there's a few, I guess I won't name names on the pod, but there's a couple names that, have fixed energy contracts, have super low debt relative to assets. or relative to equity. And so those are the guys that I would keep an eye on. And I think also it's a pretty fair conclusion to make that you'll probably see a lot of M&A and consolidation in the mining space. And then I think the last thing to kind of hit on with miners and hash rate is, I think over time you probably see, if there was a way to basically look at the amount of passive hash rate versus outright mining operations that were set up to mine, I think you probably see the amount of quote unquote passive hash rate increase over time as a percentage of overall hash rate. I think as you see guys like Shell and Exxon kind of dip their toes in the water with Bitcoin mining, and some of these entities that are basically, whether they're flaring off excess energy or whatever it may be, take what you and Jason were doing, for example, with the tires early on with ETH mining, right? I think you'll probably see a larger portion of people who have what is essentially free energy or extremely low cost energy tap into Bitcoin mining. That maybe Bitcoin mining just wasn't a large enough industry and Bitcoin was too small for them to even think about getting involved in it. But with Bitcoin surpassing $1 trillion asset class, and of course isn't there right now, but still multi-hundred billion dollar asset class, I think it's large enough now that some of these bigger energy producers can step in and kind of use it as a way to monetize what otherwise would be wasted energy. I think one really cool example of this is the Great American Mining Company. When you look at what they're doing in the Midwest, I believe, they have what are essentially traditional miners that are out there, digging in the earth, actually physically pulling things out, like not computing with Bitcoin miners. And of course, they're flaring off their excess gas. And there's all kinds of environmental restrictions on how much they can burn off every day, and that also causes a restriction on on their profit margin, right? Because if they could operate 24/7, they would, but there's restrictions on the energy that they're allowed to burn off into the air. And so you bring a Bitcoin miner out there, you say to these guys, hey, look, you give us this energy for dirt cheap, or even free in some cases. We benefit because we have super cheap power, which allows us to be a profitable miner. And at the same time, it benefits you guys because you're able to operate for a longer period of time because you don't have to burn off that excess energy. And so I think as a percentage of hash rate, I think the kind of amount of passive miners will probably grow over time. And so when people talk about, it is such a bad time to be mining right now, I think at the same time, as we continue to see these guys who have just extremely low, energy costs come into the space, I think that'll be what kind of drives hash rate, into the future.
Will the public miners stay public, or will they be forced into the private market? Like there would be like M&A and kind of these take privates just to get them out of those public markets, or is it the capital market so important to them just to survive?
I don't know. It's a really good question, right? Because like a large portion of the hash rate that came online was largely driven just by debt, right? In the end of 2020 and early 2021, we saw a lot of the big public miners take on substantial amounts of debt. But I also do wonder, I guess it just depends on the type of entities that come in and step in and buy what are essentially distressed assets. And maybe you have some of these larger kind of TradFi firms or big energy firms that step in and take these guys public. I just don't exactly know who the entities will be that come in and step in and do the M&A.
When you look forward 2023 and into 2024, how do you feel? Are you bullish? Are you cautiously kind of optimistic? And when you think we're going to go sideways, like give me a little forward-looking perspective.
Yeah, sure. I think, first of all, the outlook and case for digital assets is stronger than ever. I think the FTX situation proved that. And I know there's a lot of kind of, Bitcoin maxi types that, listen to this podcast, but I think you have to really appreciate, if you look at a lot of these DeFi protocols, they continue to operate flawlessly throughout the entire, debacle of FTX and all the other major, lenders in the space. And the reason for that is, no one's getting extended unsecured loans off of one phone call, as Kyle Davies said that Three Arrows was able to do. It doesn't matter who you are, you have to maintain the same LTV as everyone else in these DeFi protocols. No one gets any special treatment based on their connections or anything like that, right? And so, a lot of these protocols just operated completely flawlessly. And so I would say, with that, while at the same time you had all these centralized players blow up, the case for DeFi, I think, is stronger than ever. So that's one thing I would say. And then on Bitcoin specifically, I think the kind of need for, a non-political asset that is for enemies is stronger than ever. I mean, if we look at all the kind of geopolitical craziness that took place this year, you now have countries that are trying to move off a dollar standard as, the U.S. basically said that they're going to be using SWIFT as a weapon moving forward. That's kind of their big bazooka that they could pull out, and they immediately pulled it out once the Russia Ukraine situation began to unfold, and they kind of showed their cards of the kind of biggest move that they could make from like a non-physical war standpoint. I think that was probably the biggest move that they could make against a country without physically going to war with them. And so I think with that, a lot of countries, and this is something China's known for a while, as they've stopped buying U.S. treasuries, you can essentially just get completely cut off from your reserves, and that's what happened in Russia earlier this year, and the entire financial system. And so I think you have a lot of countries that are probably waking up to the value proposition of BTC over the last year. Wouldn't be surprised if you have sovereign wealth funds or central banks in developing countries at least that are probably accumulating some BTC down here.